Hey everyone, and welcome to this week's On the Spot. I'm Zach Strickland here with John Paul Hampstead, as always, our
Hello,
director
Zachary.
of Passport.
Yes, Passport Research.
Yeah, which is a phenomenal little thing that you guys do over there. So I was reading some of your reports yesterday.
Yeah.
You guys put out a weekly trucking report and an intermodal report.
Right, and we
Now-
do a special topic as well.
Right. Yeah, and you do the special topic every week, but we've talked about those a few times on here. But I was reading the intermodal report the other day, and there's some interesting developments on the intermodal side. So we had some intermodal
Right.
has been in
Good volumes
declining
on a weak
environment.
comp.
Yeah, so it's been a little bit better, and we just had Hub Group announce
Right.
a pretty good fourth quarter as well. So. What have you guys seen in the intermodal sector? I think it's been kind of a surprising sector. I mean, we've had Mike Bodendistel, one of our market experts here. He's talked about it as being like, don't get too excited just yet.
Yeah.
But it is an interesting development.
I mean, so going through earnings season, management commentary about intermodal was really constructive and positive. They're looking at it as a growth engine, but at the same time, what they're doing, it's sort of like actions speak louder than words. And so earlier last year, Union Pacific had cut 65 intermodal services, so essentially routes that connect the west to the east. They cut those. They started reactivating those. At the same time, they don't want to, even though trucking spot prices are still falling, they don't want to adjust intermodal down to sort of reestablish that intermodal savings kind of margin that shippers really depend on to justify slightly slower service. And the other thing that we kind of found really interesting is that, Union Pacific COO Jim Vena talked about this in the earnings call, but they're taking what was originally 6 intermodal terminals in Chicago and reducing it down to 3. Weirdly, initially in the earnings call, they characterized this as an investment to improve,
That's fascinating too, because
fluidity in the network.
We've seen the Chicago market on the trucking side specifically has had a pretty rough go of it this year. Volumes have declined roughly, I think they were down as much as like 20% in the summer, year over year, in terms of 2019 versus, of course, the robust 2018 that we all talk about. But they stayed pretty subdued for the remainder of the year, and they still are looking a little bit softer. So I think it is interesting to see that they may be almost projecting that Chicago is going to
stay soft.
Yeah.
Or so here there are two kind of real possibilities here. One is that they because what we have to think about is not Chicago as it is today, but as Chicago is in a high volume environment.
Right.
Which in 2018 it was the center of sort of this epic intermodal snarl that saw dwell times spiking. Savvy brokers, IMCs, and trucking carriers were able to take advantage of that,
Right.
and sort of pick off some volume from the rails. Chicago is kind of the hub of the North American rail network, along with
the center point.
St. Louis and Memphis, where
Yeah.
it all kind of connects. But another thing, which is kind of interesting, and this speaks to your earlier point, when Vena was at Canadian National, he sort of masterminded this redesign of Canadian National's network that kind of sort of redistributed intermodal volumes away from Chicago simply because it was so congested. And so this might be something where you see more volumes directed to places like St. Louis and Memphis instead of Chicago.
Interesting.
Kind of a rebalancing of Union Pacific's intermodal network. We don't exactly know how it's going to shake out. It could simply be the fact that they want, they're cutting costs and they want to just jack their operating leverage. So when volumes do return, they'll make that much more money.
Right.
And service be damned. We don't really know if that's the case.
I mean, you would think in an environment like we're seeing today, where truckload spot market really on a slide, softening significantly compared to 2 years ago for sure, that the intermodal would actually, need to decrease their rates as well, and they seem to be holding a little sticky.
They are.
Yeah.
They are, and so far, I think either, affirming we'll see movement in intermodal markets when trucking markets course correct, or when public equities investors kind of start asking harder questions about volume growth.
Right on. So the rest of the trucking sectors. So we had a few more earnings on
Right.
the side, and we see them, projecting out because they always want to kind of mitigate whatever the analysts expect, because that obviously has an
This is the
impact on their
bottom.
stock. Yeah.
This is the worst it's going to get.
Well, I saw Werner, who
Yeah.
of course beat expectations by roughly 7 cents in earnings per share, which was surprising.
Yeah,
I think.
more than a 10% beat.
Yeah, that's a pretty big jump.
Yeah.
They gave a projection of saying that they expected spot market rates to be as low as like 15% down in the first half of this year and about 5% down in the second half. So even they admitted that this was kind of a conservative estimate. But I think some of our data is pointing to not necessarily that much of a decline in the spot market overall in the through the rest of the year. Do you agree?
I don't see how it could keep going down that much further. I mean, if you look at like sort of the broader industry assessments, they're again right around operating costs, right? Like 130, 140 a mile.
Yeah.
Right. So it's like it doesn't really go that much further down on an average basis.
Sure. Well, it almost can't, because I mean we've talked. I think this recurring issue of like increasing costs. Every single one of these earnings calls has the same thing. Insurance costs have gone up 50 to 60%. The nuclear verdicts are out of control. I mean, that's not an unlikely
Right.
theme, but it's hard to imagine that they can actually tolerate, going down much further than they did in 2019.
Yeah, we actually think that capacity sort of peaked in the second quarter, the second half of 2018. If you look at the quarter-on-quarter percentage growth of Landstar business capacity owners, their leased on owner operators,
Right.
that growth quarter over quarter peaked in second quarter of 2018, then went negative in the
Right.
first quarter of 2019. So it's been declining for 6 quarters straight. It's been negative for I think 3 or 4 quarters straight. We think that means that
Supply side contraction.
yeah. And so at a certain, and that's sort of like a measure of absolute capacity, like sort of the direction that the number of trucks is moving. And eventually, absolute capacity will impact relative capacity, which is where we're talking about when we speak of tightness or looseness, capacity in relation to demand. So at a certain point, that will flip the market. And we know things are moving in the right direction. We know it's only a matter of time. And some of it depends on international trade. Some of it depends on industrial production numbers, which are positive. We're getting really good data from payrolls.
We should talk about the industrial production thing, because we just had a positive tick in the PMI, the ISM, the Institute of Supply Chain Management,
Purchasing
benchmark,
Managers Index,
Purchasing Managers Index, and it went all the way above 50 for the first time
since July 2019.
And so this measures industrial activity. Supply chain managers are surveyed by it. So when it has this big uptick, now I was talking to Anthony Smith.
Essentially,
about
what
this.
it is it's a survey where they ask supply chain managers in manufacturing companies, are you expanding operations or contracting operations this month?
Right.
If the majority of them say they're expanding, then the score is going to be above 50. If the majority say contracting, it's going to be below 50.
Right.
So it went back above into expansionary territory.
Slightly above 50. So it's essentially
50.9.
So there is some positive. So combine that with the intermodal volume uptick, and there's almost like reason to be a little bit optimistic
Bullish,
about the industrial side of the economy.
Right. Which has been the underperformer for all of 2019.
Right. Because we watch the retail side. The consumer is still spending money. Unemployment rates are still historically low. The housing and construction market actually recovering from what was a soft period of time in late 2018, early 2019.
Now, honestly, we've seen PMIs tick up not only in the United States, but in the broader Eurozone, Germany, and China as well. The January data, sort of pre-coronavirus, looks good. So I think it's kind of interesting. It's like it's one of the, like no one wants to kind of jinx it, but it's like, did the Fed engineer a soft landing or not? What's going to happen to the macroeconomy? Maybe there's no recession this year. Who knows?
I mean, the signs are pointing away from that at this point, are they not?
Yeah.
I mean, we're seeing positive numbers in most regards. Everybody's kind of waiting for this bottom. Even the trucking market, even though I know it still looks like, the problem is that we hear these quarterly earnings reports and they're kind of backward facing,
Right.
and they're also accounting, so there's going to be timing issues in those accounting figures. You're going to have things that push those ORs up and down that aren't related to the overall economy in general. But
that's right. In every transportation company has to make different operational choices and sort of decide on a strategy to respond to a certain set of market conditions. And
Right.
so, for example, C.H. Robinson, we saw sacrificed margin to hold the line on volumes in the
Right.
fourth quarter after getting punished by the market for dropping market share in the third quarter.
Right.
Whereas Echo Global Logistics, which just reported earlier this week, really sort of was able to hold the line on its gross margin. I mean, they call it net revenue margins,
Right.
but the difference between what your customers paying you and what you're paying carriers, that margin only compressed by 70 basis points in the fourth quarter, which we thought was a win, and down to 16.9%, which is a solid truckload brokerage margin.
Sure.
There's a lot of things you have to suss out and account for when you're sort of taking the earnings in aggregate and trying to use them as a sort of backward-looking view of the fourth quarter.
Right.
Different companies have different revenue mixes, exposure to different verticals, different operational sort of philosophies, different market strategies.
Sure.
Well.
And the fourth quarter is a different animal entirely, in terms of retail peak and the holidays, and you have a number of working days that are diminished. So you have all sorts of weird mechanisms in the fourth quarter.
It's another example of like fourth quarter idiosyncrasy is Uber Freight. So they reported yesterday, Uber Technologies did. Uber Freight, of course, the brokerage operating in U.S., Canada, Netherlands, Germany, and Poland.
Right.
Now their revenue was flat, like almost exactly flat, $219 million on the quarter versus $218 million in Q3. It's kind of weird. It's like, okay, that goes totally against like
Right.
like a company with $11 billion in cash that's burning it like crazy.
Mm-hmm.
But they also had flat quarter on quarter, like Q3 18 to Q4 18 was also flat, and then they kind of turned growth on again. In the quarter, they cut their losses from $81 million to $55 million. So
That's pretty tremendous.
Yeah, they still lost $55 million on $219 million in revenue, which, I mean, is not something most 3PLs are in a position to do. But it's this weird thing they do where they pause, they reconsolidate, and then they turn on growth again.
It's your common like expansion contraction. You look at economic cycles in general, and you see this kind of extinction event, and then it goes back up again. It's like short-term contraction, long-term expansion, and as long as that expansion is outweighing the contraction, you're doing all right, and especially in a high growth model.
Yeah. So there are lots of interesting. That's why actually we love earnings seasons, because we have such good data into sort of the market fundamentals, like volumes, capacity, and price.
Right.
And of course, broken down in 135 geographic freight markets. But what's so fascinating is just how all of these individual companies make decisions about what to do, what they think is in the best interest of their customers, their shareholders, their employees, and sort of how they navigate those markets.
Yeah, you kind of have to back up and take a look at the big picture every now and again just to see where you're sitting, in the overall scene of things. I think the market itself right now is, obviously in kind of a lull. We're in that January to February moment.
Right.
You can't get lost in the moment right there. This is normal. Volumes are actually flat year over year, even though capacity may feel like it's a lot looser to some. But it's going to take some time for us to kind of dig out of this trough and see this. We normally need some sort of event to kind of push us into the next phase of growth.
Right.
Yeah.
Yeah. So we're looking for that in probably the second quarter.
Yeah.
Right.
Second quarter
Into the first quarter.
Typically, March shows us something, and then of course June, as usual, have something for us. It may not be what we want, but it should be something at least that'll move the needle. Well, that'll do it for this week's On the Spot. Thank you so much, JP,
Thanks,
for
Zach.
hanging out with me today. And stay tuned for more updates from FreightWaves.